Welcome to this webinar, the Big Picture Outlook, and why it is a trader's dream to become true. So we already see here, right, this bubble. So what bubble is that? Well, the debt is counting, right? So that's what we talk about today. That has a huge impact on the big picture outlook. Now, everybody thinks about debt bubble, thinks about the USA, right? I mean, there are only just a few, like less than a handful of countries that have no government debt at all. But everybody thinks about the US, right? I think Japan is in a much worse situation than the US. We've got somebody from Japan here in the call, a former student of mine who's trading Forex, Chi. And we're going to hear his opinion as well of what is shown here. Then we're going to see, okay, the big currency shifts. That's a term I'm using for 2 years. We already clearly see the impact of that, especially if we think of the Japanese yen. The shifts are in full force, and they will get stronger and stronger over the next 10 to 12 years. And this then leads us into the big picture. It comes with a recommendation. We'll look at a couple of charts, right? So the best trending opportunities, 2024 and beyond. Then we open up. And in the end, I'm going to provide my offer, special offer. My last offer sold out very quickly. And the waiting list was building up. So I don't want to let people wait for another year, because I only teach once a year, right? So I've decided to open up a few more slots with a unique link that is basically only available for you guys here in the webinar. And then we talk about, okay, what's next? What can you do next? So why the US as far as the debt bubble is concerned? Why Japan? Well, this is the US yen chart, right? If price goes up, that means that the yen is weakening. If price goes down, means that yen is getting stronger. Now, this is a multi-year time frame, right? This is the last couple of years. And we can see how the yen has lost dramatically in value, right, against the dollar. Well, not only against the dollar, against basically all other currencies. And the Bank of Japan has stepped in just recently here and here to intervene for a stronger yen. And that happened, right? It went down. I talked about it in my newsletter. It was nothing special. We actually expected before the intervention occurred, we expected a healthy pullback back to the 21, which occurred. But these interventions, right, of the Bank of Japan, they have been very, very expensive. And there was this news coming out later, right? Let me just bring in people. There are people trying to get in. 1 second. So a couple of days later, it was in the news, right, that the Bank of Japan intervened. They haven't intervened for around 25 years, right? So that was a very unusual thing. And this is the first intervention in October, and it was very expensive, right? It cost $48 billion for them to sell US dollar on the balance sheet, right, of the Bank of Japan and buy back yen in order to increase the price of the yen, right, the value of the yen, and that led to a drop here in price. But this is what we heard. Well, there was another intervention in November. Well, that was, I guess, equally expensive, because price came back to this important level. I guess that was very astonishing and frightening, right, to the Bank of Japan, and at all costs, well, they pushed price lower. We can see that the reaction was really shallow. We didn't even get, it was only halfway. We didn't even get to the 21 moving average. So back in 1998 was the last intervention, the Bank of Japan, right here. So that was the Asian financial crisis. Some of you might remember that. That was a very scary moment in time, right? Several Asian countries, I remember, were really in trouble. And this is when the Bank of Japan stepped in as well to support the value of the yen. You can find that in the press as well. Now, this move, right, that's an explosive move. It basically went from slightly above 100 to 150. So in a very short time, the yen lost value of around like 40%, 45%. Was that a surprise? Well, if you know a little bit about patterns, well, it was not a surprise, right? Because we were expecting that back here. And 2 years ago, I talked about that chart, and you might remember that this is an S1 pattern, S1 long pattern. And when we talk about a pattern, well, we're basically expecting a measured move of what happened before, and that happened before. And what we got here is basically a perfect measured move. This only goes slightly higher. So from a charting perspective, that was not a surprise, right? But to many market actors, well, it was a surprise. Now, was it a surprise that the Bank of Japan got nervous around that level? Well, actually not in hindsight, right? Because they had intervened before. That seems to be a very important level. It's a long-term level, the 150 level, and they've intervened here. They intervened again. And we have just this week, right? This Friday, we have closed slightly above the 150. And let's see what's going to happen over the next couple of weeks and months. This level is very important. The more price remains at that level, the more energy is built, right? And if they cannot keep it below that level, we'll see a pop, right? We'll see a pop higher. And that will be very expensive, right, for the Bank of Japan, as other central bank interventions have been very expensive for the central banks. So everybody talks about the US. Well, let's have a look at the US. So these are the US government expenditures on government bonds, right? It's US federal interest payments. So they went dramatically up, right? Just recently, they actually doubled. They doubled between 23 and 24, right? Huge increase. This is the interest rate expenditure. Well, where did the increase come from? Well, it basically started here, right, with the great financial crisis. All of you, I guess, can remember that there was a lot of money printing, quantitative easing going on, right? So the debt was inflated. However, the yields went down, right? We even had negative yields. So that basically, kept, right, the interest payments that have to be paid. Well, over the last couple of, I think it started with the Ukraine conflict, right? That the yields went up. And this is what we see here. We've got a big amount of debt, and suddenly the yields go up, right? And the result is, well, that's what everybody feared, actually. Everybody thought, well, the yields can remain low. Well, they cannot. And we can see what happens if they go up. Well, suddenly interest payments, well, they have doubled within a year, right? That's obviously a problem for governments, especially if the debts are high. In the US, it's high, right? It's 125 debt per GDP. That's quite high. However, if you compare it to Japan, and this is why I say the real problem, well, the bigger problem is in Japan. It's not so much the US, because in Japan, the debt per GDP is well above 200%, right? And the US, it's in this area, so there's a huge gap. When did it all start with Japan? Well, it was during the real estate, once the real estate bubble went down, and I found it here with Reuters. Japan's descent into the debt trap began in the 90s with the burst of a real estate bubble. The problem was further compounded by high demand for stimulus packages, which has caused Japan's debt to continually pile up. So what does that mean? It's a nice description, right? A demand for stimulus package. Well, that's quantitative easing, right? Printing money and buying debt. And the debt went up, right? Well, the good thing for Japan was that the yields were low. They were even negative. And a couple of years ago, the chef of the Bank of Japan was asked whether he was financing the state, right? Like printing money to keep the state afloat. And he said, no, you see it with the yields. The yields are low, right? So he's not financing the state. Well, that's obviously, nice to have, right? Printing or building up debt and having no yields, right? No interest to pay, or even negative interest to pay, which means that, well, you get money, right? The state gets money from the investors buying the government bond. Well, let's have a look at the next page. This shows the yields, right, of the Japanese JGB 10-year bonds. So the yields, we can nicely see it here. They went down, right, lower and lower and lower, even into negative territory. And this was due to the, I found that in the press, it's not my invention here, due to the ultra loose monetary policies, right? So very aggressive quantitative easing, right? The state was buying the debt and was lowering the yields even into negative yield, not just for a year or two, right? For several years. We can see it here for about 5 and 6 years, right? And we can see it with the ratings. I mean, this doesn't go unseen. The ratings have fallen, especially if we compare it to other countries, right? Japan to lift assumed. So now what happens now is Japan to lift assumed rate for debt servicing for the first time in 17 years. So this is what we see here, right? So now the yields go up. The latest estimate served as a reminder that the cost of financing debt would shoot up as the central bank leans toward exiting pricing mode stimulus. I mean, these are nice descriptions, right? You want to read in between the lines. What does that mean? They're leaning towards exiting pricing mode stimulus. When people read that and they think, well, it doesn't mean anything, right? Well, it means actually a lot, right? It means that they're not going to aggressively buy bonds anymore, right? It means that they cannot keep the yields low, right? It means that basically this low yield environment is over, and that this is a huge thing, right? During this period, like over 20 years, it has been a down yields. Well, this is over, right? It seems like. Well, they have taken a decision to leave that strategy. Well, why? Well, probably because it's not possible to hold it up anymore, right? This is what we have to assume. Looking at the charts, now during this time, 2015 to 2022, the yields were negative in the US, in Japan, right? So during this time, during this flattening plateau, the yields were negative. Let me just bring in some people who arrived. And let's see what happens, right? When yields were no longer negative. Well, this is what happened, right? We see this explosion, right? Price popping. This is basically starting in 2022, right? This is the entry signal of the S1 entry stop. And this is the popping, right? So the market basically understands that something serious is going on. So money is leaving the yen, right? The yen gets weaker and weaker. But actually, the market knew this before, right? Because the pattern has positioned itself. And I always say that the pattern tells the story, right? And the pattern knows better. Well, it actually knew better, like 5 or 6 years before, knew better that something would happen. This is a webinar I gave in 2022 at the same time at the Institute, Vanthorpe Institute. We were right here, right? And I was talking about that something like this is going to happen, and it happened, and we see the Bank of Japan stepping in. Well, this is the US yen chart. The yen is weak, right, against all currencies. And now let's have a look against a strong currency, which is the Swiss, right, Swiss franc. Strong currency versus a weak currency. Well, we see a huge increase in price. But again, here we had a pattern on a monthly chart, an S1 pattern, very, it's a big move. The stop appears small, right? And we're basically running through here. It can be nicely see we're cutting through stop run levels. We talk a lot about stop run levels as we talk about patterns. This was a stop run level. This is the stop run level, and this is the stop run level. And we can see how price, with a lot of force, right, goes through these levels. And typically we get a consolidation, then it continues, we get a bigger consolidation, and then it just continues with the trend. Well, let's have a look at stop run levels here on the US Swiss chart, because we see the same thing. This is a stop run level, 1, 2, 3, 4 stop run levels, right? Your price goes through easily, right, with a lot of momentum, and then it tackles another stop run level further back in the past, and this is the last stop run level, right? So this is this big move. This is not yet. This is what we call a stop run move, right? Breaks the level and then runs. This has broken the level, the important 150 level. However, this is not what we call a stop run move. It's just testing the level, right? So when the level breaks, we should actually move towards the 160 or 165 level. This is a stop run move, right? And everything is setting up here for putting in a big move against the intervention of the central bank. Now let's have a look. Let's have a look at the big currency shift, because we have seen here, right? Some currencies are super strong, like the Swissy. It's a very special currency. It's a small one, right? Switzerland is a small country, but it's a very special country. They never had war, right, in their history. So it's it's a safe harbor. And we've got the yen that has difficulties with its debt levels and the debt and the servicing of that debt levels, right? So now we're coming to this concept of the big currency shift, because every country, well, in these times today, right, every country is basically facing difficulties of a different sort, and this basically the differences are so big that it creates currency shifts, right? It's like an electric impulse, right? It jumps over from one cable to another. That's how you can compare it. So let's have a look. I've done the analysis based on pattern analysis on the bigger time frames on the monthly chart. And this is what I came up with. The top 4 strongest currencies and the weakest, the bottom 4 weakest currencies. Why is this interesting? Well, it tells us about something about the big picture, and well, we know something about the trends, right? So if the Swiss is strong and the yen is weak, well, we would like to trade the Swiss yen long, right? Etc. So we can make these combinations and know, okay, this should trend up or it should trend down. So Swiss is should be the strongest currency over the next 10 years. That's the big picture outlook and the currency shifts associated to that. Strongest currency. Well, then I was looking, okay, what type of currency is it? Well, it's a safe harbor currency. Interesting. Okay. Next one, very strong, is the Canadian dollar and the New Zealand dollar. Well, what are these? Well, these are commodity currencies. Okay, interesting too, right? Then we've got the US dollar. It's still a bit of a swing factor. It could, over a couple of years, it could actually get stronger, but over the next 10 to 12 years, it should actually weaken a lot based on a pattern. Well, what is the dollar? It's a world reserve currency, right? Then the weakest ones is the British pound and the euro. What do they have in common? Well, they're close to each other and they're close to Ukraine and Russia, right? Geopolitical conflicts and tensions. We have even weaker is the Australian dollar. Well, that's a surprise, right? I would have thought the Australian dollar is close to the New Zealand dollar, because that's a commodity currency as well, right? However, Australia is highly dependent on China, on the economy of China, and something might happen, right, with China and the relationships between Australia and China that actually leaves many people leaving the Australian dollar, right? So that seems to be a very weak currency. And the weakest of all of them, well, the Japanese yen. I'm not referring here to fundamentals or my own opinion. I'm just looking at the charts, right? That's a charting view. I'm looking at the patterns. And the yen is by far, that's why it has 5 arrows down, is by far the weakest currencies of all. And the Swissy, by far, is the strongest currencies of all, right? So that is strange, right? A safe harbor currency is top, and the highly indebted is bottom. Well, maybe it has something to do with each other, right? Maybe there will be unrest, right? If a debt bubble, the debt bubble is a global thing, right? It's just the biggest is in Japan of the developed world. So if something is going to happen, if the fear increases that we might have problems due to the debt bubbles and the service and the payment of these interests, well, we might see a lot of money go into the Swiss franc, right? Because that would trigger a sovereign debt crisis. And that means that countries go bankrupt, right? We've seen that in the past. It's nothing new. But in these situations, where does the money go? Well, it goes to find a safe place, right? Well, it's a Swiss franc and it is the dollar because it's a reserve currency. But the dollar, the US is highly indebted too, right? So what we will be faced here in this big picture outlook is that money wants to move, right? Money is scared, finds out that it needs to move, but it doesn't really find a safe place to hide, right? And this basically sets up this pressure that money is moving like kind of very hectic and sometimes even in panic, will move to one asset class from one currency and from one asset class to another one. This is not only that not only has an impact on Forex, but it has an impact as well on the commodity markets, right? So we're going to see, that's my outlook. We're going to see big and spectacular moves as we have seen already here with the yen. And this is going to gain momentum. We're just here in the start, right? We've got the first 2 years started these big currency shifts. And well, big trends, big moves, more volatility, sustained trends. Well, what is that? Well, it's great for traders, right? It's basically a trader's dream becoming true. This is the chart, Australian dollar, New Zealand dollar. Typically, they're very closely correlated. But again, here, something is going on, right? We've set up a couple of stop run levels. And as far as the charts tell, we should see a drop of 30% in value of the Australian dollar versus the Kiwi dollar, which is rare because nobody could tell me a reason for it, right? I've asked my Australian friends, there's really no reason for it, why this should happen. So the patterns and the market knows in advance, right? And we're going to see, we're going to find out, basically. This is the US dollar, right? Very long-term view from 2000 to 2025 years time span. Here we've got a huge S1 pattern long. We're still below the critical level. And we could get both moves. So we could get a short move, a strengthening of the dollar, but long term, we should actually see the dollar getting weaker and weaker, especially when it breaks the green line higher. Right. So what is now the concrete big picture outlook, and what is the recommendation? Let's see. There's some chat. Somebody has posted something in the chat. Daniel. Hi, Daniel. Yeah, exactly. Yeah. Big picture outlook. Let's make it bigger. Okay, I cannot do that. The debt bubble around the world is the mother of all bubbles. It's the biggest bubble. Right? There are many bubbles, but the debt bubble is the biggest bubble in terms of money that is in there, right? And I think Japan will be first. Then comes Europe, and then only finally the US. Everybody thinks, oh, the US is first. No, it never starts in the core. It always starts right at like what is far away from the core. And it might even start with a smaller country. It might start with Turkey, or it might start with with some other emerging market country. And Argentina, for example, has a lot of difficulties, right? So when interest rates increase, that's what we see now in Japan, governments will get into difficulties to service their interest payments, obviously. This will intensify the underlying fear that government papers are not 100% safe anymore. And then that's what we call a sovereign debt crisis, that governments could fail, right? The money will try to find a safe harbor but there is no real safe place to hide. And that could trigger basically something like a great financial crisis, 2.0. Just this time, it doesn't start with an investment bank going bust, right? It might start with a government, right? With the government going bust and everybody getting nervous, and then it spreads, right? Funds will slowly reallocate, like funds, big funds, right? Pension funds, investment funds, family office, institutional investors, and retail investors will slowly reallocate slowly, right, from government papers into harder assets. I mean, institutions, big funds, they don't move from one day to another, right? They go slowly. They think in years, basically. And they would want to go into harder assets. So what happened during the great financial crisis, 2008, was that money was actually fleeing into government papers, right? Because that was the safest place to hide, 100% safe. Well, if you start great financial crisis 2.0, and if the problems come from government papers, well, it's difficult, right? Because everybody was hiding at government papers for many years, right? And well, this is why there's no place to hide anymore. People, funds, and money will not know to go anymore. Well, they go to places that are harder assets. The debt bubble will start to lose pressure slowly because money is flowing out slowly but steadily. And it's like busting a balloon with a needle, but it's not like a flash crash, but slowly over time. Funds will try to hide in safer currencies, for example, the Swiss franc or the US dollar, right? Moving from the weak into the strong currencies. Only small amount of liquid funds coming from government papers because it's so big, right? If only 1% goes out of that big pot of money, it's sufficient to create bubbles, right? Popping up in other asset classes. If you think of the Swiss franc, it's a small country, right? If some serious money gets into the Swissy, well, it will bubble. If serious money gets into gold or silver, it will bubble, right? And this is what we're basically foreseeing. Currencies will bubble, metals, energies like oil, crude oil, natural gas, stocks, right? Cryptocurrencies, real estate. So this is where money coming from government debts, well, is trying to move into, right? And well, this situation will scare many people, right? When government papers are not 100% safe anymore, and when the pension funds get have negative news, and when people's pensions might be unclear how much they get, because pension funds can get bankrupt too, right? Well, this will scare many people and make them undecided and nervous. But remaining in government papers will scare them even more, right? So the fear of missing out, because there are bubbles popping up in Bitcoin, right? A lot of people are not yet invested in Bitcoin or in gold or in silver. The fear of missing out and not acting at the right time will be huge. So a lot of pressure, right, on people and funds and companies, right, and governments. So there's the fear of a debt bubble burst, and then there's the fear of missing out when money is moving, I mean, rapidly, right, from one end to another, rapidly, like within months or years. So people and institutions will feel trapped, right? And when a market actor is trapped, that's actually a very good situation for a trader, right? Because once a trap is shut, big moves are happening. And System 1 basically capitalizes on a double trap, right? Trading Forex futures and crypto offer great trading opportunities, I think, right? I honestly think over the next 5 to 15 years. The good thing with those asset classes is that they're fully flexible and you can trade different currencies, different asset classes, right, in futures, and different time frames, from the long-term time frames to the very short ones, down to the second chart. And these markets are 24-hour markets, nearly, right? And they can be traded around the world. which is nice. And they trade 24 hours a day, nearly. So bubbles will pop up at different times. And over time, funds will move from one currency or from one asset class to another. Example, silver will bubble, right? It will go above 200 per ounce. Well, then people will think, oh, that's a bubble, and they will get out of it, sell it, and go into another asset class that has not bubbled yet, right? So money will move around. Or when the Swissy bubbles, well, then people will think, oh, something is wrong, it's too high, right? Well, they will get out of the Swissy and they might go into, I don't know, in the US dollar, for example. So this is for traders and investors. This is the ideal market scenario, but only if you're flexible, right? It's basically a trader's dream and something you can capitalize on if you're not getting frozen, right? If you know what's going on and what might happen, it's a bit scary, obviously, but if you know what's going to happen, well, you know what to do, right? And this is a very important thing. Get mentally prepared, so to strive, financially. This is the idea. Now let's come to the recommendations. Well, we've already seen spectacular moves in all those markets, Forex, futures, crypto. But these moves, they will get even bigger, right? We have not ended. They will go bigger. We've just started. And this will let most people stunned if they don't understand what is the underlying reason for it and why. So especially those who do not understand what is going on, they will be stunned, right? And they will freeze in fear. With volatility already high, this will only intensify over the years as the big picture unfolds. So we're going to have more uncertainty, more liquidity, because governments, they will fight against. So there will be more and more and more money printing, as we've seen with the Corona crisis, right? A lot of money was printed to counteract the crisis. Well, we'll see more money printing in most of the countries to fight that. So more money, more volatility. This mix, right, is actually, it's an ideal situation, market scenario for a trader who is flexible. Volatility is the trader's best friend. Now, my recommendation is you don't want to get sucked into negative news, right? Reading the papers, everybody's saying something different, everybody's confused. If you focus on the charts, right? I only look at the charts and the patterns. I think about fundamentals as far as the outlook is concerned, but then during the year, well, I basically look at the charts, visual patterns, because the patterns, they tell the story. And during these times of bubbles, well, trade the trend, never counter trend, right? A bubble can go much, much higher than you would ever, like a trend could go much, much higher than you would ever have thought. Because when it's getting into a bubble, right, it goes vertical, exponential, which is what we've seen with the crypto market several times over the last years. So we're going to see a lot of asset classes behave very similar to the cryptocurrencies, get into an exponential trend, right, a bubble trend, and then end, and then money goes into another exponential bubble trend with another currency or asset class. So the visual patterns tell the story and trade the trends. That's basically it, right? So you need to diversify and want to capitalize on huge trends, being flexible, right? Moving from time frame to time frame. Different time frames will bubble at different times as well. If you trade what you see, like you see the charts and analyze the charts, especially the pattern and the trend, then managing your exits is relatively easy, right? And then things should work out really, really well, right? With the big picture unfolding, it's a global thing. We are looking at a scenario the world has never experienced before, right? This global debt situation. And the centuries before, it was like one country, right? Germany, or that had problems, but everybody else was fine. Well, nowadays, it's like one big country, right? It's the world. The world is impacted by this. And you basically want to get ready and capitalize on it, right? Protect yourself your family, your finances. It doesn't mean that you need to trade the 1 minute chart, right? You could be an investor and capitalize nicely on these trends, because these are big trends that go over years. So there will be unique trading and investing opportunities for the next 10 years, 12 years, 15 years. And important is you don't need to be perfect, right? Because the market will be in a chaos. Everybody will make a lot of mistakes, right? Get in at the bubble high, right? These type of things. You don't need to be perfect. You only need to be slightly better than your counterpart. And being aware of the big picture, well, that puts you already in a good position, right? Not to do things you regret afterwards. So I think we're going to see a huge and incredible ride as far as price action is concerned. And you want to trade the markets, right, while staying safe and in a good mental state, right? Looking at the charts and not getting too much influenced by what you read in the news. There will be a lot of scary news coming up if the trouble really starts. You don't want to get impacted by that, right? Because that immobilizes. You want to be in a good mental state and try your best, right? And there will be a lot of opportunities, right? You will not catch every opportunity. You will get stuck with one or the other position and lose money, right? But overall, I think this will be a very good decade. I'm looking forward to it. Now, what are the best trend opportunities as far as Forex is concerned for 24? So I've checked out the charts, right, the patterns, and this time the higher time frame patterns on the monthly chart. The US Swiss looks very good, going for a stronger Swissy, right? This is an S1 pattern, a multi-year S1 pattern that triggered back here. I've talked about this, 8 years ago, right? 10 years ago. This was your original stop. Well, it was never hit, right? We've got lower highs. Well, it didn't move a lot. I was expecting something like this coming out of this entry. Instead, it's building pressure, building more consolidation. This is another S1 actually on a weekly chart. So it's building more and more energy. It's like a compressed spring, right? And if the compression goes away, well, you know what the spring does? Well, it expands, and it will expand something like this, even more, right? Because more and more pressure is built. So we should see more Swiss strength over the next couple of years, right? The time horizon here is like 3-4 years. Next one, US CAD. So the US dollar looks pretty strong here. This is an S1 pattern, and this is the stop run level. I just want to show you what is the stop run level. Stop run levels are exposed levels like this, big wicks, right? Highs with big wicks. These are perfect stop run levels. And here even we've got a double stop run level. That's even better. So if price gets there and breaks the level, this is another stop run level, a big number, the 15,000. Well, we should get a big move, a stop run move, meaning price goes vertical, right? You see even one big green bar or a series big bars, and it should go at least here or even up here, right? You should see a move like that, an exponential up move. Well, that's a monthly chart. If you get a move like this, similar to what we've seen here, right? This can be nicely traded in a lower time frame. We don't need to trade the monthly chart, right? It can be traded on a 15-minute chart, on a 60, on a 5-minute as well. Whenever we get an exponential trend going. This one here, Euro Yen. So this goes for a weak yen and a stronger euro. Again, here we've got a stop run level, right? Clustered with a big number. And we're basically shooting here. Price is shooting for that level, right? If it breaks the level, well, it should shoot up here, right? Similar move we've seen here, probably even bigger bars, right? Going exponential. Looks very strong. Well, this is what we talked about already. If this level breaks, I don't say it breaks in a month or 3, maybe it takes 6 months or maybe a year. But if this level breaks and the more touches come in, the stronger the move coming out of it will be. And we're looking for a measured move, right? The initial target is this. But the measured move is basically we're looking for this, right? For such a move. And such a move should bring us to the 190, 200 level of the US yen, right? This one as well, New Zealand. So the Kiwi is strong, right? One of the strong currencies, and the yen, the weakest. Well, we've seen that before, right, on the chart. This is an S1 pattern. And the low was the corona pandemic fear low, March 2020. That was the absolute low, right? And since then, well, it's running its course through the stop-on levels, and it looks like it's about to break the consolidation high. This is the most important level. Like if that breaks, again, we get a move and it should bring us to the 110 level. That's a long way to go, right? Now, looking at this chart, this is very pronounced level, right? Pandemic. And this is a very pronounced level. Well, that's a great financial crisis back then, right? Looking at the chart, we see two pronounced levels, financial crisis and Corona, right? Pandemic low. And if we look back like in 10 years from now, we'll actually, I'm pretty convinced, we're going to see that the Corona pandemic start was a major turning point, right? And we see it in the chart already, major turning point, comparable to what was here in 2008, 2010, the great financial crisis. So important will it be, right? The charts tell the story well in advance, and I solely rely on chart, right? On charts. All right, so let's open it up for Q&A. It will take us a bit more than an hour today. Okay, Daniel, what about currency controls? Capital movement controls, they've certainly happened before. Is there any history of what happens in the tradable markets like Forex when a country imposes currency controls? Yeah. Well, in the euro contract, right, of the European Union, there's actually a paragraph that they can do that. They can limit or freeze the movement of the euro. So yeah, countries can do it. Well, what happens? Let's say you're I don't know, you're in US dollar and you want to get into the euro, you mean? I think, I mean, it will not be like they freeze everything. Well, they will limit it, right? They will say I don't know, only 20,000. You can only bring in or out 20,000 per month, right? They will start like this in order to limit things. Okay. Okay, Petra. Good to see you. Okay, other questions. So is this scary what you heard, or is it like what you would have expected to? Chi, yeah, speak up, please. Chi's from Japan.
Hi, can you hear me?
Yes, very good.
Yeah, good to be back with you and all the traders here. And just like to give a little bit input at everything but Gabriel had mentioned earlier in this seminar is really true, and we are slowly suffering from the weakening of yen. Entire nations are suffering. So it is going to be worse because the Japanese government is not going to increase the rate because increasing the rate is going to squeeze their neck to pay back the interest that the government is borrowing from the nations. So I am really taking this risk as an opportunity to be rather building the wealth as a traders and investors point of view. Also, just one thing, it is not just correct what the Gabriel said earlier. In 2023, Japanese government has not spent $8 to intervene. What happened in November last year was the short squeeze of the Japanese yen in the CME, Chicago Mercantile Exchange, Japanese yen futures, right before the Thanksgiving, because the institutional investors were pulling the dollar from the market. So at the end of the December, we found that the Japanese government did not do any intervention. That would naturally happen. But anyway, people were very much interested in shorting the yen. And just because of a little bit of squeeze occurred, a lot of people got scared and pulled the Japanese yen, the dollar back. But now the rewinding is occurring. So I think this situation is going to become worse. Worse means worse for me, for the Japanese nations, because the governor as well as vice president of BOJ has recently answered the interviews that once they quit the yield curve control from minus interest rate to zero, but they are not going to increase. That means they are silently telling the market that the low interest rate will continue. So that's what I wanted to speak for this morning. Thanks, Gabriel.
Okay. Thank you. So you say last year November, that was not a Bank of Japan intervention. October, yes, but November was squeeze.
October 2022 was yes, but not that 2023. Not even a dollar has been spent from foreign currency reserve.
Okay. Max, hi Max. Do you expect any market caps imposed by central banks? What do you mean with market caps? In what sense?
Yeah, the same as Swiss bank imposed at some point to 1.2, and maybe what I'm trying to say is, do you expect any unexpected shocks from central banks, like you're in a trade, and they will start to move currency that can be dangerous?
Right. Well, the euro and the Swiss pegged its currency to the euro, right, at 120 for 2 years. Well, they couldn't hold it a long time. I was actually along the Swiss, right, when they pegged it, and the peg led to a weakening of the Swissy. That's what the Swiss National Bank wanted back then. Well, I had a stop in place, and I got out.
It worked when they intervened this one.
Yeah.
Okay, because I was actually, I know that when they impose cap, then you have to stay away. But before that might be unexpected.
Right. Well, the problem was with the Euro Swiss peg that there were people trading with the Swiss National Bank, right? They were saying, oh, we're back at the peg, so I'm going long the Euro Swiss because the peg holds. So they were trading with the Swiss National Bank instead of basically against it, because no national bank can ever hold it up forever, right? And once they couldn't hold it up anymore, well, the currency dropped like a stone, and there were traders with big sizes, right, trying to take little moves because the peg moved a little bit, right, and they got bust. But the currency brokers, they how do you call that? Well, some of those had big losses, right? Some of those investors, and it was covered by guarantees of the brokers. Many Forex brokers have guarantees, right?
But we can protect when we know it's cap. You should be careful. But before cap, like you said, you were in a trade, and if they move the currency, if it stop get triggered, then it's okay.
Sure, yeah. That happened to me. I was heavily along the Swissy, then the peg came now. Yeah. Okay. John, I just returned from Argentina and noticed the price of a tasty blue cheese, which I purchased, had risen 29 times. Well, there's a huge inflation, in Argentina, yeah. Rüdiger, hi. Interesting times to come. I think you will prepare us to take advantage of the coming changes. Luckily, lucky to be in the Forex workshop. Okay, great, yeah. Well, I'll talk about this topic, right? Repeatedly, and try my best to inform you, right? Without having the Holy Grail. Okay, any other question?
Yeah, thank you.
Yeah, pretty good. Hi to Germany. Okay.
Gabrielle, I have a comment.
Not, yeah.
Yes. So you talked about this stuff about a month ago in one of the masters webinars, and I was very afraid. I had a lot of fear,
Uh-huh.
and
I
and
remember
I
that.
noticed that, yeah, and so I noticed this time I'm more used to the idea. I have less fear, and one of the sort of methods that I used to deal with my fear was that I remembered that when I was a surfer, I used to like it when a cyclone was coming because I knew it would produce big waves and I could go out and surf bigger waves. And so I'm sort of using that idea in the same way of going, okay, there's unrest coming, there's turbulence, and it will produce big movements. And I guess traders are like surfers of big trends.
Yeah.
So I've been using that idea to try and help with my fear. Yes, I hope that's helpful to someone.
And you don't have to ride every wave, right? That's obvious for a wave for a surfer, but not for a trader. You don't need to ride every wave. You don't need to ride the monster waves that you're fearful of. But you should start, right? Small, surfing the smaller waves and then getting to the bigger ones, right? So it needs time, basically, right? First of all, mentally to get prepared. I remember you were scared, but you heard it for the first time, right? And well, I was scared too when I started to have these ideas, right? Okay, thanks to Australia. Thomas,
thank you.
Well, the war is resulting in green products flooding the European markets. Yeah, I know. And farmers are protesting the deflation of food prices because of this. Yeah, a lot of turbulence coming up, right? Not only what I talked, now we're talking here about, actually products, right? Crossing borders. Absolutely, yeah. Mike, artificial intelligence. I'm not sure you mean artificial intelligence on trading or? Okay, Joseph, you're talking about the 2024 trader group, yeah? Well, that's basically the group that is forming with my workshop now, that is starting now in 3 weeks. I'm not, my job is not done when the workshop is done. It's a 5-day workshop, but it will actually start after the workshop. I'm training you guys through a group mentoring, and I'm carrying you over to become really good traders. The recording will come out tomorrow of this call, and I will post the link. Yeah, and the link will be well, it's limited, right? The seats are limited, but you don't need to react within a day or two, and it's time limited because the workshop starts in a few weeks. But I'll post it, and I will send out a newsletter tomorrow with this recording, and I'll post the link as well. Okay, well, let's come to the workshop and the offer. Share my slides again. Okay, all right, let's see offer. So I'm offering it, I'm now on my own, right? I've been with the Van Farb Institute before. Well, now I'm doing it, organizing it on my own. And I like to have a good start, right? Like with a good number of people. It already sold out, so I'm opening up new slots now, 25. Some of those are gone because there was a waiting list, so people acted already when they sent me an email in beforehand. So I'm offering it with a big discount, right? It's a 40% discount, and it's a 5-day workshop, including 2 days of live trading. The workshop is described on my website. The price you see there is the 3,995 on my website. This price you only get with a unique link I'm going to send you. Right? And with the workshop, well, there's some bonus add-ons. I'm not going into detail here, but they're really good value. This goes along with the workshop. So my mission is to transform you or traders into consistent traders within less than a year. It's my mission, and it gets better and better as my group mentoring got refined over the years. So the first day of the workshop is the 14th of March. That's when we start. It's on a Wednesday. The second and the third day is on Saturday and Sunday. Right. So what's next? I recommend you to read my article. Just posting it. The market rewards you with big R's. It nicely shows you with real examples of traders, right, coming out of prior workshops on how you can trade the markets based on patterns, how we build pyramids. And it shows you a nice example of one of those big moves, right, that were experienced in the currency market. Well, let me paste you the link, the unique link with the price I've shown you before. Yeah. By the way, with the workshop, there's a 100% satisfaction guarantee. I continue what I offered with the Institute. After the first day of the workshop, if you don't like it, no question asked, or you get a full refund. Then on my website, just putting it here, you find a lot of useful information, articles, and my YouTube channel. Oh, I'm sorry, I've typed it wrong. I'm getting more active with my YouTube channel, actually. I've just started my weekly Trader Insights free newsletter in October last year. And if you have any question, just ask me. That's my email. And I recommend you actually to go and watch the Forex Trader Development Series, the 6-part series, in total 30 minutes. Basically tells you how I approach trader development and what I'm offering once the workshop is over. And the next one is a playlist in YouTube, which gives you a sneak preview about the workshop. So I've pasted both links. As well, if you're interested, my last article was about the 12 key success factors to become a successful trader. I think that's it's kind of a summary of what I've learned the last 10, 12 years coaching traders, the 12 factors that are really important to become successful. I think these are unique factors, and you wanna read about it on my webpage. If you sign up for my weekly newsletter, well, you get a download of the article with additional links to watch, additional information. Anything else? Well, again here, my offer to you: join the Trader Group 2024. We always have nice groups, right? A committed group that sticks together and supports each other. So that's Trader Group Forex, only once a year. And well, I guide you to become a trading pro. Basically, my vision is to establish the world's trader hotbed #1. I'm actually applying principles of deep practice to get there. And my mission is to develop successful trader talent within less than a year. For some, it's actually much less than a year, even shorter than 6 months. And for some others, it takes more than a year, no problem either, right? What is important is incremental progress. Free webinar. I'm holding one more before the workshop. We're going to talk more about trading opportunities that are developing at that time. So we're looking at the shorter time frames. This was more the view onto the higher time frames, right? In the big picture. Okay. Good to see faces. I know Sean, Max, and Mark, and Holger. Great to see you. All right. Take care.